Morning, Steve Free in Chicago with the morning grain comments. Well, we've got prices down. Corn, beans, and wheat. The stock market is a little bit higher. Dollar's higher and crude's lower. I think overnight there was some talk that without clarity in the U.S. and China trade deal, that could offer resistance at these current price levels. You know, we need some clarity to push beans over $9.50 and corn over $4 and wheat much over $5. We also note that the 11 to 16-day U.S. Midwest forecast looks warmer and drier, so we should be getting into the fields. For now, the commercials are talking about early yields are supportive of the USDA's October yields. The problem is we just don't know about that last crop that was planted in June and what the yields are going to be there, whether that drags down the U.S. yields or not and makes things tighter as far as carryouts are concerned. My concern as far as a rally is three things. Number one, we really don't have the export market to support prices going higher. Number two, option volatility should be a lot higher than it is now if we have a quote-unquote problem. And number three is everybody expects 2020 to be a normal year. So normal crops worldwide and especially here in the United States should push the 2020 Dees corn and wheat and November bean contracts lower than they are now. I think there might be still one little bump up in prices in the 19 contracts before we start seeing pressure on the new crop 20 contracts. Cash basis levels, though, here in the central Midwest are much firmer than normal and quite a bit higher than a year ago. I think that's partly due to the late harvest and the fact that the farmer's not selling. So you're seeing some pretty high basis levels still, despite the fact that we're approaching like 30% harvest for corn and soybeans. So farmers not selling and the cash basis supports to the nearby market. So don't expect much of a sell-off, even if we get one, until we actually see some cash movement. A lot of data, a lot of reports out of China overnight suggesting that their economy is slowing down more than what people had thought. This could have an impact on global economy. The interesting thing is that as far as the trade deal is concerned, the Chinese would like U.S. to drop their tariffs before they come in and buy this U.S. ag goods. The problem is that I would think the U.S. would like to see China drop their tariffs at the same time so that they could come in and buy U.S. beans. There was one report that already the Chinese have bought 700,000 tons of pork, 700,000 tons of sorghum, 320,000 tons of U.S. cotton, and 20 million tons of soybeans. Now, to date, our export sales data is nowhere near that amount, so we're not sure if these amounts are yet to be reported or amounts that total they could buy down the road. But again, especially for pork, this would support higher prices in the hog market. And again, as far as South American weather is concerned, it looks like things are improving down there with rains in Brazil and mostly favorable weather in Argentina. So again, the three things that I'm worried about as far as a price rally is our export demand, big world crops in 2020, and the fact the option volatility is not showing that we have a price reason to rally or a problem. As always, these are my thoughts and not those of ADM or ADM Investor Services. Have a safe and profitable trading day.